All right, but first, let's start off by focusing on the IT space. Cloud has been a key driver for IT companies with strong growth over the last few years. But are we headed towards a slowdown? Rima is standing by with all the details on the big wall. Rima.
Thanks so much for that. So cloud, as you pointed out, was a key driver for IT companies' strong growth over the last few quarters. IT companies roughly earn about half of their revenues from digital solutions, most of which is directly linked to cloud offerings from hyperscalers like AWS, Microsoft Azure, Google Cloud. While the growth of these companies is still very, very strong, there are some signs of slowdown which are emerging. Ambit says cloud moderation indicators are emerging, though not fully conclusive. Let's break this up into three brackets. First, hyperscalers like AWS, Cloud, Google Cloud, that is, Microsoft Azure. Second, the SaaS companies. And third, the equipment providers to cloud companies. So starting with the hyperscalers. Now, hyperscalers' growth has slowed down in the current quarter. Take a look at the numbers of Amazon Web Services and Google Cloud. In the quarter ending June 2022, that's the current quarter, revenue growth for Amazon Web Services was up 33% on a year-on-year basis, but it's lower than the 37% growth that it had in the March quarter. Similarly, for Google Cloud, revenue growth slowed down from 44% to nearly 35% on a quarter-on-quarter basis. Secondly, even SaaS companies are warning of some slowdown, and there have been some guidance cuts, worries about elongated sales cycles. So one of the companies, Salesforce, trimmed its full-year revenue guidance by 200 basis points to 20% constant currency revenue growth versus 22% earlier. ServiceNow, another company, trimmed its full-year revenue growth guidance by 50 basis points. And other companies like Zendesk, Duck Creek, Pega, they're all warning of elongated sales cycles. And finally, the third leg of this, these are the equipment suppliers to cloud companies like Seagate. And Seagate just last week downgraded its Q1 FY23 revenue forecast. The company said incremental weakness on enterprise side was seen due to a cautious buying behavior among global enterprises, OEM, and certain US cloud customers. So the question that we're now asking is, why is the current macro slowdown that we're currently in impacting the IT companies, the software companies, the tech spending? Well, let's just take a step back. Now, post-COVID, clients opened the floodgates for discretionary spending to accelerate for cloud migration, digital transformation initiatives. But after 12 to 18 months of accelerated spending on technologies, the current uncertain macro has made enterprises take the foot off the pedal. Enterprises have now renewed their focus on cost savings and programs which generate a quick ROI, return on investment. Even as the digital transformation over the longer term, the initiatives still continue with full swing. But now what's happening is that tech budgets are receiving higher scrutiny. They require a greater level of approvals from the CFO office, C-suite, or even the board. And this is resulting in slower decision-making and longer deal cycles than we've seen in the past for software companies. Even in segments which were perceived to be relatively resilient, like data analytics, low-code, and automation. And as I said that, while there are certain red flags which are emerging, broadly, the enterprise market still remains very, very resilient, and digital transformation journey is continuing and even strengthening in a few cases. So the long term is still perhaps very much intact. But the question is, if there's really a broad-based slowdown in the enterprise level decision making and it gets worse, can the Indian IT companies remain immune, or will there be a trickle-down effect? Let's tell you the read-through from Indian IT. Kotak says that they believe tech spending, that is a function of the natural growth in business, can be impacted in a weak demand environment. For example, cloud consumption growth can decelerate, not necessarily because clients are slowing down cloud migration or their digital initiatives, but due to a lower storage or compute requirements in the case of an economic downturn. Vendors too, the vendor commentary indicates that digital transformation trend will only continue. So they're saying that FY23, we're unlikely to see a slowdown, but there could be a deceleration in growth FY24, which is something the street is already expecting. Back to you.
All right, Rima, thanks a lot for taking us through all of those very interesting details. In fact, we also have a guest joining us now. Ravi Menon is joining us from Macquarie. Ravi, good morning, and thanks a lot for joining us. This is Pavitra. So you just heard the entire presentation that Rima put out, and you know what? We were just talking about the kind of contribution that we get from cloud for a lot of these companies. While we're not seeing a very significant slowdown right now, do you think in the future it could get even more pronounced? And then what is the kind of impact that it could have on Indian IT?
But I think this is excessively bearish. I think our Asia Tech team actually revised up its cloud capex guidance. So we are looking now at 22% growth in capex. And usually cloud capex has always been followed by revenue. So revenues track that pretty much, which would make sense, right? Because you put up the servers and then rent them out afterwards. So I think that if we are looking at a slowdown in calendar year 23 in cloud revenues, you would have actually seen a slowdown in capex, and we are actually instead seeing an acceleration in capex. So I think that we actually should expect to see good cloud revenue growth even in calendar year 23, that is FY24 for us. And we are actually still seeing enterprise hardware spend on PCs and laptops be pretty strong. Dell in its recent results actually had only worries on it actually saw declines on the consumer side, but its enterprise laptop and PC sales are up 15% year on year. And enterprise server networking revenue is up even higher, 16% year on year. So I think enterprises generally make cuts to hardware first because that's a easier postponement in spending without an impact to deliverables that you promised business. So I think that without seeing a cut in this kind of hardware spending, very difficult for me to see a cut in IT services spending. And as far as software, we've heard of that. So I think that while these are all very large firms, you should look at the long tail of clients. I mean, beyond the Fortune 1000 that Indian IT services firms cater to. So I think the small and medium business market, the SMB market, is what Salesforce actually has a large exposure to, apart from the large enterprises. So I think we can't really correlate, what happens to a company like Salesforce with thousands of customers versus someone like, say, a TCS, where probably what happens to the top 100 or 200 customers matters a lot more.
So you're still very, very optimistic. Can you tell us what is your forecast for growth FY23, FY24 and thereafter? So the street is expecting some slowdown will take place in FY24 because of the current situation. The base effect as well kicks in. But what about thereafter? Because markets tend to price in, say 3 years, 5 years out hence in growth.
Right. I think that FY24 and FY25 estimates, especially for TCS, look excessively bearish to me when I look at growth estimates. For this year, in constant currency terms, we are looking at 14% growth. Because of the considerable cross currency, that's actually 10.3% in dollar terms. So next year, we are looking at that coming off slightly, right? Like you said, one is the base effect. Two is that possibly there may be some slight, caution in spending. So we have estimated 12.5% in dollar terms growth for next year. And then FY25, we expect a pick up again to 13.1%. Now, if I look at consensus estimates, it's more around 8.3% dollar revenue growth for FY24, and pretty similar to that for FY25, which I think, from a 14% in constant currency to an 8% growth, that's a pretty sharp drop. We don't really think it will be that bad. I've not seen anything like this outside of the global financial crisis.
So you're saying for the next, say, 5 years, TCS can see, double-digit kind of revenue growth? Because it's not... Yeah, go ahead. Say 12%.
Sorry, I was just saying that I think... Yeah, I think that is definitely possible. I mean, 13% perhaps a little excessive, but yeah, 11-12% I think is a reasonable expectation, unless we see significant slowdown in the US turned into a major recession. Unless something like that happens to derail spending plans, I think with corporate balance sheets so strong, we've actually already heard Jamie Dimon talk about what in the event of a US recession, what will we do? He said that he doesn't think that tech spend can be started and stopped just like that, just like you can't stop opening branches or hiring people. So I think large companies with strong balance sheet will continue to spend, and that's actually the clientele that matters most to Indian IT services providers. So I would expect this to be fairly robust, and this is a major technology refresh. I think the largest technology refresh in 20 years. So I think this is going to be a good cycle of 3, 5, even 7 years.
Okay, so you're still continuing to sound extremely optimistic. Also, comment on the margins, because that is, of course, a big area where a lot of doubts are raised on how it could sort of pan out going forward. Your margin view, of course, is also extremely bullish. But how do you see it trending for some of these larger players, the likes of TCS, Infosys?
I think Q3 will actually be when we see significant improvement in margins. Q2, we, of course, still have cross-currency headwinds as well. And some of the companies still have wage hikes to deal with, like Wipro, for instance. But Q3 onwards, I think attrition should moderate. People will have some headroom in utilization to improve. And because we are seeing double-digit revenue growth continue, we think fresher intake can actually help moderate the average cost per employee and help margin improvement in FY24 and FY25. So I think margins are not a structural issue. It was a temporary problem. I think we are seeing attrition starting to normalize, the lateral hiring market become a little bit more rational. People are not trying to, I think, compete with each other, looking at the last offer that a candidate has got and trying to offer a premium on top of that, because that's not really sustainable. You have to attract talent based on, the strength of your brand and, offer a decent pay hike, but can't just, have an auction of sorts.
Is it tough to convince your investors to buy IT now? Because the street is still divided, even after the near 30% decline from peak levels. And there are many brokerages who are very bearish. Like JP Morgan, for instance, has downgraded Indian IT. You're optimistic. How tough is it to, convince your clients to go out and buy Indian IT at these levels? And what is the pushback that you face? What are the key concerns in the pushback that you face?
The concerns are precisely what you raised, Rima, so I'm trying to address them best I can. And I think when I raise these points, people do say that this is fair, but I think most people have been hurt by the PE derating that has happened already. People do agree that it offers good value at current levels, and people are interested in looking at it. But I think people are waiting to see some signs of improvement in attrition, some margin improvement, all that. So I think it might be another 2-3 months before people really pile into this. Or I guess we have to see repeated precision. Otherwise, then this again becomes a defensive sector. Normally, it would have seen that impact already, but we had significant cross-currency headwinds dilute a lot of that.
And just for the near term, considering the tenuous macro environment, do you think there is scope for further PE derating?
I don't think so. I mean, if you look at, say, HCL Tech, that's a 4.6% dividend yield. I think, what's the downside from here? I don't see much. I think that's exactly the same. I mean, if you look at TCS, I mean, you're looking at free cash flow yield of 4% plus. So these are stocks that used to bottom out at 2% dividend yield. I mean, now we actually are significantly ahead of that, and we still haven't, seen people come and be very eager to take up positions. So I think it's just a matter of time, and people are just looking at the worries about U.S. environment getting worse. I think when that clarifies a little bit, we actually will see people turn more constructive.
Ravi, thank you very much for making this appearance on CNBC-TV18. Look forward to more chats and conversations with you. Thank you very much for joining in.
Thank you so much for having me.
Get into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins us next.